$4.4 billion in cash, $162 million in sales, and not a single dollar of profit between them. Those are the three quantum computing stocks everyone is trading: IonQ, Rigetti, and D-Wave. And right now, the headlines are screaming that they face a cash crisis, a make-or-break test just to survive to 2028. In the next few minutes, I'll show you why, for these three, that headline is mostly wrong, and why the number that actually decides who is still standing isn't the size of the cash pile. It's a number almost nobody quotes: Runway. This is a thesis check. Market arithmetic, not a trade to place. Start with what burn actually means, because it is the whole game. A normal company earns more than it spends. These companies do the opposite, by a mile. IonQ, the biggest, brought in about $130 million last year and lost around $500 million. In just the first quarter of this year, it burned through $150 million in cash. That gap, money out minus money in, is the burn rate. And once you know the burn, one simple division tells you how long a company can last. Cash on hand divided by how fast that cash is spent. That number is the runway, the years of life left before the tank hits empty. Everything about surviving to 2028 comes down to it. Now, here is where the headline falls apart. IonQ has by far the biggest cash pile, about $3.1 billion, more than the other two combined. So it must have the most runway, right? Not even close, because IonQ also burns the fastest, and its spending is accelerating as it buys up other companies. At its recent pace, that $3 billion is roughly 5 years of fuel. D-Wave, meanwhile, holds less than $1 billion, a quarter of IonQ's cash, but it burns a fraction as fast, which stretches its runway closer to a decade. The company with the most money is not the company with the most time. Cash pile size is the scoreboard everyone reads. Burn rate is the one that actually counts. And a fair warning, these runway numbers are rough, and they move as the burn moves. Treat them as orders of magnitude, not a stopwatch. So who fails the 2028 cash test? On cash alone? None of these three. Every one of them, at its current burn, is funded past 2028, and some of them far beyond. The real cash crunch in quantum computing is happening to the smaller, thinner-funded names you rarely hear about, not the big three the crisis headlines are actually attached to. So, if you are worried that these three might run out of money and simply vanish in the next couple of years, the arithmetic says that is the wrong worry, which raises a much better question. If survival is not really in doubt, then what exactly is the market paying for? Here is the catch the runway math hides. That runway is not fixed. A company can extend it almost whenever it wants by printing and selling new shares to raise more cash. All three do it, constantly. And it works. The tank refills. But someone pays. Every new share issued makes every existing share own a slightly smaller slice of the same company. It is a quiet tax on the people who already hold the stock, the price of buying more time. So they have plenty of runway, and shareholders keep getting diluted, are not two separate facts. They are the same fact, told from two ends. So, what is the honest verdict on the quantum cash test? Survival, for the big three, is mostly settled. They have the money to keep trying for years. But surviving is not the same as winning. Being funded through the end of the decade does not mean the technology pays off. It means these companies get years to find out, on their shareholders' dime. And that is the part the cash crisis headline gets backwards. The real test was never whether they would run out of cash. It is whether a business doing $100-some million in sales and losing more than it earns is worth what the market charges for it, roughly 100 times its sales, and for two of them, several hundred times. The cash test is the easy test, and they pass it. The valuation test is the hard one, and that verdict is yours to make. Educational analysis only, not advice. Do your own work before acting on anything.